Good day, everyone, and welcome to today's class. And today we are going to be talking about what? We are going to be talking about functional strategy. And if you remember during the introduction class, we say that according to what GSW, let's say that we have three levels of strategy. We have what we call the corporate strategy. We also have what we call the business strategy, and we also have what we call the functional strategy. Or some texts will call it operational strategy. Operational strategy. And don't forget that we have three elements of strategic management as well, according to JSW. They say we have what we call strategic choice. We have what we call strategic position. We have choice, and we also have implementation. Or sometimes we call it action. So our focus today is about functional strategy. And from the word functional, or sometimes we call it operation, is a strategy of day to day. Just like in accounting, we have our working capital. Is the strategy that we need for day-to-day running of the day-to-day running of the business. And before we now start talking about strategy, every one of us here, we know the functional area. If you look at your organization, you can identify some functional area in your organization. So in this functional area now, so once you're able to determine the functional area in your organization, the next thing that we now need to do now is we need to be talking about the strategy that we need to make this particular functional area to be successful. That is our strategy. So what are your functional area, like your finance, your marketing, your production, your R&D, your HR, and you also have your marketing. So basically we'll be talking about 6 strategy today, starting with the finance. And this is a very important aspect in terms of sometimes you can be asked to do because and let me tell you something. I think I sent a work on business on financial strategy, and that is on ratio analysis. One of the key work in financial strategy is 3. The key work in finance strategy is 3. One of the work that a finance strategy will do is we call it low cost business. In terms of the finance, the cost accountant now can tell us that these are we can do these are we can reduce our these are we can reduce our cost. That is the work of that is the work of finance. They can tell us that these are we can do these are we can reduce our cost. That's a cost accountant can a cost accountant can do that. Then another thing that a finance strategy can do, we can just note this down. I'm still going to explain as we are moving on. 1, low cost business. Another one that a finance strategy can also do, they can do what we call differentiating a business. We call it differentiated business. And they can also do one work called financial ratio analysis. And at the skills level, at this level, the only subject that I know that there's no ratio analysis, I'm not really sure, is taxation. Whether it is in public sector, whether it's in your your FR, at least in your financial, that's part and parcel of that. Whether it's in what else course do you do in the CSME that we are talking about, whether it's in audit as well. In audit, there's ratio, but in audit, we don't call it ratio. We use what we call analytical procedure, and that's ISA 520. So we don't call it ratio. But the tools that we use for analytical procedure is ratio. So ratio analysis it cuts across everything. The only one that I'm not sure, I didn't know, is taxation. The remaining other 5 subjects, there's ratio analysis there. And to some of us that are doing financial reporting, this will be a good advantage to you. Because under finance strategy, we can provide you a financial statement and ask you to analyze it. And let me tell you, if you want to analyze any financial statement, the first thing that you need to do is the first thing you have to do is First of all, read the financial statement, because as you're an accountant, one of the tools that we use is what? Is ratio analysis. And the beauty of it is that what? I lecture FR as well. So most of the time now, the way the examiner is what? Is setting the question at that particular subject is now. Nowadays, the examiner is not giving them what? The examiner is already giving them the ratio to use. The examiner could have calculated the ratio for, oh, gross profit margin is this, last year is this one. What you are now meant to do now is for you to now analyze it. And ratio cannot be what? No, I sent the question as well. Ratio cannot be the same. There will always be a gap. Please don't forget what I'm saying. Ratio cannot be the same. If you calculate gross profit margin of what last year, let's say it is 20%. This year, it is not 30. You can't have the same what 20%. There can also be what? There can be increase or there can be decrease. So whenever you are now what? That is not enough. As an accountant now, some people will not understand the meaning. Oh, you calculate now gross profit margin. You say it is what? 20%. Okay? Some people, some manager that you are reporting to, they do not understand that. That was the meaning of what? 20%. And that's why you need to what? You need to analyze it for them. So here also we do analysis. And that's one of the work of what? Of the finance. That once we calculate it, we say gross profit is what? Gross profit divided by sales, right? Multiplied by 100. Oh, it is 20%. Then I will not tell you what happened. That, oh, maybe the reason why the gross profit margin increase maybe is as a result of what? Increase in our revenue and decrease in our what? In our cost of sales. So the first thing, please, I want you to know this down. If you want to analyze what? If you want to analyze a financial statement, you have the question already. We are still going to talk about that. Because I'm still what I'm still saying is still part of the question that I sent to you. We are under finance strategy now. If you want to analyze if you want to analyze a financial statement, the first thing that you have to do is what? Calculate the ratio first. You calculate it. Then the next thing that you have to do is once you are done with the calculation now, the next thing you have to tell us now is identify the gap. Maybe last year now it is 30. This year it is now what? 20. You can see now there's a gap. The next thing, which is the third one now, is that you need to tell us the reason. That, oh, last year we have 30%, now we are now having 20%. What caused it? What caused this? Then once you identify the reason, you have to tell us the fourth thing that you have to do now is what? Tell us how we can improve it if it is good. Sorry, how we can improve it if it is bad, and how we can maintain it if it is good. If it is good, how can we maintain it? Last year, our gross profit margin was 30%. Now we are now having 50%. It is something that is what? That is good. So you have to tell us, how can we do what? How can we improve it? And if it is bad as well, you have to tell us, how can we what? If it is good, you have to tell us, how can we sustain it? How can we maintain it? Pace. But if it is bad, how can we improve it? And now, what you now need to do now, at this level, I know every one of us, maybe you have come across FR before, you have what? Note to the account. You know, if you are doing your publish account now, you are going to say what? You have a working or a note that you say what? Cost of sales. So in the financial statement, if you look at the question I sent to you now, they will only say what? Cost of sales. So assuming that the gross profit margin has the gross profit margin has dropped, but the revenue has what? The revenue has increased. What I now need to do now is that the reason why that gross profit margin has reduced now is as a result of what? Increase in cost of sales. So what you now need to do now is that you now need to know what make up cost of sales. You need to know what make up what? Cost of sales. Because in ratio analysis, we are not going to be provide you with the note to the account. So you now need to know what now? You need to know the element that build up what? Cost of sales. Opening inventory, your purchase, your carriage your carriage inward, your closing inventory, your return outward. Those are what? Those are components of the cost of sales. So once you know the component now, I will now pick one. Ratio analysis is something that is very interesting. If you are doing it in the exam, what you just need to do is you have to be mindful of the time. So I will now pick one now. Oh, Gross profit margin last year is what? Is 30%. This year it is what? It is 20. The reason for what? Decrease in what? In gross profit margin is as a result of what? Increase in what? Cost of sales. That is fine. Then you have to tell us that how can we improve it? Oh, one of the way you can what? One of the way you can reduce your what cost of sales is that, oh, maybe you should buy in bulk, economic of scales, so that you're able to enjoy what? You're able to enjoy discount. Maybe you should try as much as possible to reduce your what? Your inventory, because inventory comes with cost. And that's why we have what? JIT. We see our production strategy. I'm still going to talk about that. We have what we call what? Just in time. So finance what? Finance strategy now. Finance issues are relevant to what? To strategic planning. A finance objective is normally the what? The main corporate objective of the what? Of organization. We all know this. Most organization is what is to make a profit. But you're still going to make the profit, but make the profit in a what? In a good way. Let me tell you, every one of us that you're listening to me now, if you what? You are not a government. If you establish a company now, a private organization, I'm not talking of the NGO, the profit motive is there as well. Okay. So even for a not-for-profit making organization, its main objective will be limited to the availability of the finance that they have. So a not-for-profit making, how they are able to function as well, it will be determined by the finance that they have. How much do you have? What is your budget? And the finance function within the entity provide a strategic support function to the entity to achieve a corporate to achieve your competitive advantage. Because if you want to achieve a competitive advantage, it's not something through the word of mouth. You want to be the best, the finance has to be there as well. You can't say you can't say you want to win the league now and you don't have the good player. You can't say you want to be the best company now and you don't have the right intellectual capital. Your human resources is nothing to be talking about it. You don't have a good employee. So how do you want to be the best? Because if you employ the good personnel, you give them training. Don't worry, we'll be talking about HR as well. You give them training so that they were able to attend to your customer. Right? So that they were able to attend to to a customer in a good way. But if you don't have it, so for you to now employ a good employee now, employee come with cost. You can't say you want to have a good employee now and you are not ready to pay. Where do you want to see that? And that's why some organizations usually go to tax haven in terms of going to a country where their tax is low, their labor cost is low. There are some US companies that they are in the southeast. Maybe due to they have some they are factory in China, they have some in Mexico, and some of them are in Africa as well. So because the cost of production is cheap. And I want to achieve a competitive advantage, and you don't want to spend on your employee. So one of the things that you can do sometime in management is that shift your production location. Go to another environment where their labor cost is tended to be low. You need to have you need to have financial objective as well. Your financial objective can be that, I should take care of my shareholders. And that is what the value-based management is talking about. Under value-based management, what value-based management is trying to do is that everything that will improve everything that will improve the value of your shareholder, that is what they will be doing. Under value-based management, I'm only interested on taking care of my shareholder. And one of the tools that every one of us, if we are doing performance management, one of the tools that we use what we call economic value added is in PM. Economic value added is a tool that we use to measure the economic profit, and is a tool for VBM, value-based management. So your financial objective can be many. It can be to take care of your shareholder, your stakeholders, your customer. It depends on the organization. But they are going to have a financial objective. They will have a target. Then your financial performance is also a very important thing that the finance team has to do. And when you say your financial performance, what we use in accounting now is that we use ratio analysis to measure performance. That is the tradition. That if you want to measure what organization performance, what are you going to use? You are going to use ratio analysis. But now that is a traditional method in accounting, because ratio analysis look at your what? It look at your financial statement. If I ask you to perform a ratio analysis now, is the financial data that I'm going to provide for you, not what, is not any other thing. But we now have we have some model again that is not only thinking about the finance. We have the balance scorecard. In terms of what we are thinking of the finance, but we're also incorporating other things as well. We're also thinking of how do you treat your customer, the customer perspective, the internal perspective, the learning and growth as well. So, and it is when you achieve all these three, you are taking care of your customer, your internal, the way you are doing within the organization is good, okay? You are learning as well. There's innovation. You have a good research and development. That will be good. So if these three are good, finance will also be good in the long run. But if you are the manager that you're only thinking about the finance today, you can only achieve the finance today in the short term. It can't wait. It's not something that you can sustain. Because if I buy from you today, you take the profit, but you may not I may not come back again. So when you are analyzing financial performance, the techniques and the ratio for analyzing finance should be similar to you already, because it's the things that you know already. So what are some of the things that we can do? We can do sales growth. Sales growth, and what do we do if you want to calculate growth? Or you just say that, the current one, okay? Current one minus old divided by old multiplied by 100. That will give you the growth. That will also sometimes we call it the percentage change. So you can analyze their distance sales growth in terms of what is the sales that we have last year. What is the percentage increase in our sales? We can also look at their gross profit margin and net profit. And I think we have sent the question to that. I'll open it now where we look at the question. The ratio of expenses to revenue. So we can, and that's what we call, if you're analyzing financial statement, we call it operating expenses to revenue ratio. And what is your operating expenses? Don't forget, your operating expenses comprises of your admin and your selling and distribution. That is your operating. Your selling and your selling and distribution and your admin, based on the IS1 now. Those are what we call operating expenses. The ratio of expenses to revenue, okay? The total borrowing, and don't worry, we call it that's our gearing ratio. The gearing ratio in terms of or we can have debt to equity ratio. We have many we have many ratio, and that's one of the limitation as well. In terms of we have different ratio, and there's no a standard formula for them, especially return on capital employed. And that's why sometimes the examiner may give you the basis that you are going to use, the denominator, because sometimes I can say capital employed equal to my total assets minus the current liability, okay? Or I can say long-term liability plus equity also. So the ratio of non-current assets to sales. And we call it efficiency ratio, or what do we call it? In terms of what we use this ratio to do is to calculate how efficiency are you using your non-current assets to generate sales. And this one is usually based on turnover. It is times, and the higher it is, the better. So if I have a sales turnover of 25, it is good. It means I'm utilizing my asset very well to generate revenue. Okay. So another very important thing, and hold on. We have financial analysis and strategic. Okay. You should also try to put your financial analysis in context of business strategy. And if you look at the question that I sent to you under maybe the additional information too, you can see that there's element of strategy there. And what this finance director is saying is that what there has been a competitors now. People are not buying. People are not buying within the what. They are not coming to shop to buy again now. They prefer what buying what they prefer buying online. They prefer to what to buy online. So if you now have a question like that, the question that we are going to give you here is to be in context of what business strategy. Maybe the strategy that they have now is not working. Okay. So and our revenue is not what our performance may not be good. So what we now need to do is that we need to change our strategy. And if you look at the question now, the company is going into a cost leadership strategy. So when you are analyzing what financial performance here, you have to think of what business strategy in terms of what this company that you are analyzing now, if their performance is what is good, which strategy can they adopt? If it is not bad as well, which strategy can they adopt? Okay, so if they are using and most of them, it is going to be most one, it will be between what either cost leadership or either differentiation, or it is a focus strategy. That is if you are analyzing financial performance here, those are the strategy that you can be coming across. Is either the company will be they want to adopt a business strategy or cost leadership strategy, they want to use a differentiation, or they are going for for focus. So, and if you have different products, different products, and that one is not, and this one is when you have a BCG. And if you remember how you calculate BCG. So you can have a financial data now, and we are going to ask you. This one is in context of BCG now. That which product is star? Which one is dog? Which one is question mark? And which one is cash cow? So what you just need to do then is calculate the relative market growth, calculate the relative market side as well. So once you calculate the two axes, then you're able to determine that which one is star, which one is dog, which one is question mark, and the rest. So we can now ask you to further analyze it now that if this one is dog, what can we do? If this one is star, how can we maintain it? And mind you, a star will later go out one day. All these products, they are moving. We call it a strategic line, meaning that they are moving. But the one that is bringing money today, which you can advise the company to try as much as possible to maintain it very well, is the star. In a layman, we call it a star today breadwinner. Today, if you are a company that have portfolios of products, you have different products, the one that is generating the sales for you today is your star. But you have to take care of you have to take care of cash cow, because we call cash cow a tomorrow breadwinner. So that if you are no more there, it is the cash cow that will be bringing the money. Just like a parent now, you are the one that is taking care of your family today. That means that you are the star. It is not something that will continue. Another person will replace you. And that's why maybe it's your children now that will replace you. When you get older, maybe you 70 years or 65 years, you'll be asked to retire. So some of the work that you are doing, you may not really have the strength. So who will also be taking care of you now is your cash cow. And that's why in BCG, we usually advise companies to try as much as possible to maintain your cash cow very well. Because if the star drop, who will replace the star? Is the cash cow. So maintaining, develop it very well. Have a good strategy for it. Put it in a good market. Because if you put a good product in a wrong market, the product will not be successful. So do a careful analysis of your of your cash cow. Because your star is already in a good market. So even though the product is good, but if the market is wrong, the product will fail. Even if your children is very intelligent, but if the school that they attend sometimes, if the school is not good, that can cause a problem. So what's not the what? And that's just like you are doing a farming now. If the product is good, but the land is not good, it's a problem. If the land is not good, but the product is good, the land can destroy the product. So analyze the good market for your what? For your cash cow. Now, another big thing you can see, I liked it in what? In red. In green, which is, please don't forget this. You can see it is what is in green now. So I'm telling you that is what is very, very in green now. I'm telling you that it's very, very important. So this one can just come like a 3 mark now. Oh, what's the role of what accountant now? Because we are talking about the finance now. So you as an accountant, as the finance team, what are your role in business strategy? And don't forget, we say what a business strategy can also be called what? A competitive strategy. A competitive strategy, a strategy for you to win. So as an accountant also, we have a role to play. So what is our role? Whether it's in business, whether it's in what operational, whether it's in functional strategy. What is the role of the accountant? Provide a system for recording financial transaction and preparing the annual financial report. Provide a system, a good system for recording financial transaction and preparing annual financial report and an account. Provide management information system and procedure for decision making in terms of our budget, our capital investment appraiser, that before we go for a certain project, analyze it very well. Don't worry, very soon, I pray by next year, you'll be learning about You'll be learning about some of this thing, investment appraisal in strategic financial management. And that's one of the main functions of finance manager: investment, financing decision, and dividend decision. But the most important one is is the investment decision. So as an accountant, we should provide a good information in terms of make a good budget, have a good budgetary control in place as well, so that we control the budget. Capital investment appraiser, and if the company is saying, as an accountant, I want to have I want to have a new branch in or we want to buy a certain equipment, provide them with a good appraisal of it. And one of our mentors is that we use NPV. If the project have a positive NPV, then we should go for it. A discounted factor analysis, which is about your discounted factors. This one is about incorporating your cost of capital. So use a good cost of capital, a good realistic cost of capital. Assist colleagues in R&D and marketing with new product screening and decision about whether to develop and market the product. You can assist them as well, even though sometimes it may not really be your work. Assist your You can see we say assist your the R&D, assist the marketing as well in product screening. So if the marketing is going for a survey within the accounting team, we can delegate the finance manager, you follow them as well, assist them. Strategic investment appraiser thing, which involve strategic assessment, as well as the financial assessment of the new investment project. Strategic investment appraiser, appraise the project, appraise it very well. Provide a reporting system for marketing function by providing information to customer on customer profitability, channels of distribution profitability, and as well as product profitability. Is the account that will do this. And that's why sometimes we do what we call especially in the manufacturing company, we do what we call what do we call this thing? We call it practice group report. Sometimes we call it product report, where we have different products. Then we analyze their profitability. Let's say for example now this particular product A, this is the profitability. We'll prepare it as if it is that particular product is a single unit. So this is the revenue, this is the cost of sales, so that we're able to determine the profitability of each product. The marketing could have sell what, so but we are the one that will determine the what. The marketing team will also know, but analyzing it very well is the accounting department that will do that. Work with the marketing colleague, that's the word, those are the department that we really work with as well. To assess the what, the effectiveness of the marketing incentive and the marketing mix. Helping your colleagues to what, to identify and measure what value added through what value chain. Value chain. So please don't forget this. These are the role of accountant in business strategy. It's a very, very important thing. So please don't forget the minimum of 5 is what is okay. And you can think about your organization as well. What is your role? So another functional strategy, another functional department is the research and development. And you see, this research and development is very, very what in IT. In a IT company, this is very, very popular. Especially, let's say the Samsung and Apple now. You know, they try as much as possible. They spend billions of dollars doing research. So that when if this product is launched and we're asking you to pay close to let's say, for example, now like $1 million now, if you convert it to Nigerian or currency. So we know that there has to be some value added in terms of the camera, the motherboard of the product. It comes through with the intensive R&D. Like the pharmaceutical product as well, you have to do a lot of research and development to develop a new drug. Because research and development is very, very important. Even though you are not changing the taste of your product, but try as much as possible to change the look. And ICAN too, we changed in 2021, it's not last month. ICAN also changed they changed their logo as well. Every Tuesday and Thursday now, ICAN is live on Facebook, on Instagram, and so is through research and there has to be some innovation. There has to be some new look. So let people see your product and see that, is that their new logo? Because everybody know the ICAN logo. But if you see the new one now, you may be thinking that, but ICAN is boldly written on. So that is research. Every Tuesday and Thursday now, ICAN is live. Don't worry, after the class I'll send you the topic for Tuesday and Thursday. So that that is through a research and development. Innovation is very important. You have to innovate as individual, as company as well. Even though your product, if you are not changing anything, the taste still remains the same thing. But try as much as possible to change the logo, change the outlook. If it is red, why can't you put it to be change the color, maybe some blue or something, so that anybody will just be everything is still it still remains the same thing for like 5 years now. No, try as much as possible to change the outlook. That is very, very important. So why is innovation why is it very important? We say product renewal. Changing the design of a product can help to renew or prolong its life. Changing the design can help to changing the design of a product can help to renew or prolong its life. Many products therefore undergo a design change during their life in order to maintain or to increase our sales. We have to change the design, change the outlook. That's another reason why we need to innovate. Product renewal. Another one has to do with product adaptation. A product can be adapted for a new market segment. Product adaptation. For example, a product that is marketed successful in US might be adapted by its manufacturing for sales into Europe, where customer need might be different from those of US. You need to innovate, because if you are selling if you're only selling in Nigeria now and you're planning to increase your sales to another economy, because your business environment is not the same. So you have to try as much as possible to innovate. try as much as possible to get some data about the new market that you're going. So that if the design is not really okay, then you change it based on the taste of the new market that you are going. New products, they are developing a new product. A new product are continually being invented and developed. Many product ideas are unsuccessful. However, when a product is successful, the first phase to enter the market and develop the product will often be the market leader through the product line. Let me explain what we are saying here. Developing a new product. There are some products that will develop, that will be successful, and that's all we usually pray for our product to be successful, okay? But there are some times that the product may not be successful, and that's why we have to have what we call withdrawal strategy. Withdrawal strategy in terms of what? We need to do what? We need to withdraw we need to withdraw the product from the market. And why do you do why do you have to withdraw a product? One of the reasons why we withdraw a product is the successful. If it is not really successful, that can make us to withdraw the or if it is the life cycle has expired. So a product that growth, they have entered the maturity and is not declining now. So what we can do, the next thing is we can do we can withdraw the product. So you also need to innovate so that when you are developing a new product, so that if you send it to a market today, if people are not really if you do some customer survey and the customer see that, oh, I don't really like the design, I don't really like this, what we can do is that we can change it so that you're able to meet you're able to meet your demand. Because it is when we're able to meet the demand of the customer, that's when we'll be thinking about what competitive edge. New technology as well can also bring us to innovate. Before I know, maybe the ERP that you're using in your organization, all these companies also, they try to innovate. Because before we have what do we call this product, this ERP? We have Microsoft Dynamics 2013. But now we have Microsoft Dynamics Business Center 365. And that one you can host it on the cloud. So where you are working, and you can work at home, especially if you are in the finance department. So rather than you have to be within the premises of your organization to do to enter some transaction in your ERP. If it is on cloud, you can do that. Just for you to log in and do whatever you want to do. So technology is also is also one of the most important things why we need to innovate, because things change. And if you remember, during the external business environment, we say that we have technology environment, and that's very, very to me, I consider it to be very, very dynamic, because technology change often nowadays. And a new version will come today, another version will come tomorrow. So as organization also, we also need to try as much as possible to innovate as well. There's iPhone 12 today, try as much as possible. That is not the end. If you have 13 today, that's not the end. So you need to try to innovate. And most successful organizations now, especially in this current environment, are those organizations that are innovative. If you want to be successful in this world, in this current business environment, you have to be You have to be very innovative. You have to there has to be a good investment on your research and development. If entity fail to develop, to innovate, you can say it. It will be at competitive disadvantage. If you fail to innovate, you will be at a competitive disadvantage. You'll be at competitive disadvantage. And there's no any organization that wants to be at a competitive disadvantage. So you have to innovate. And innovation can come from Innovation can come from different ways. And if you first establish a organization, innovation will come from the individual. For example, now if I establish an organization now in Yanda Limited, that innovation now, let me do it like this, let me do it like that. Most of the time, it will start from a certain individual. That's what we call the word, the entrepreneur. It just starts from that particular individual. Innovation has to come from what? From an individual or a group of individuals. When a business entity is first established, innovation is provided by the entrepreneur. And that's why, if you remember, during our last class, we talked about what? Growth. How can organization grow? And if you remember the word, the granite model, the first one, growth, is through what? Innovation. And innovation is coming from the word, is coming from a single individual. That is the word, the first stages that a company can grow. You grow through what? The first phases is what? Is through innovation. So when a company first what? You first in existence, the innovation is coming from a single individual, or it sometimes can be a group of individuals as well. Every one of us in this live class now, we can come together and what? And establish a company. Then the innovation will sit down in the table, everybody will bring his idea, then the business will be established. Okay. So a large entity can try to deal with what? Okay, look at this now. In a large entity, they have what? They have outgrown their entrepreneurship stage of their existence. There's no obvious role of what? Entrepreneur. It is senior management. Senior managers may be what? Competent in many what aspect of the management, but do not necessarily have the talent for innovation and entrepreneurship. And this is a what? This is a risk. So as a functional manager, you have to have what? The idea of what? Of bringing what? Innovation. Because as company is what? Is increasing, this one will drop. The innovation, what? The one man what? Innovation, or a group of individual what? It will drop. Then it will now be left to the what? To the functional what? To the functional managers. So as a functional manager, you can have what? You can have talent in the what? In the management, but do not necessarily have talent in what? Innovation, and that is bad. And you can see we say this is a what? This is a strategic risk. This is a what? This is a strategic risk. If you are only good in what? In the finance aspect, but the innovation aspect is not there, is a what? Is a strategic risk to that organization. If a large entity does not have any entrepreneur, but its competitors include a small entrepreneurship entity, there's a risk that the entrepreneur competitor will be more successful. Look at this statement. If a large entity does not have entrepreneur, you don't have the senior managers that can bring about innovation. But if you only have a small company, entrepreneurship entity, but they are very, very good in innovation. If every one of us here now, we can come together now and think, we can perform better, we can achieve a competitive advantage than a large organization that is full of talent management in their field, but they lack They lack innovation. You can see how important innovation is. So even though your capital base is very good, you have a large amount of your access, but if some of your management, they are only good in their field. Oh, this one study accounting. Okay, you are good in accounting. But if you lack If you lack innovation, a business organization that is not even, their process is not really well automated than you, can be successful than you, just because they are very innovation. So how can we not deal with this? Because we have to innovate. We have to achieve a competitive edge. And we say, you can see the statement now that, if organization fail to innovate, it will be at a competitive disadvantage. And we don't want to be at a competitive disadvantage. Samsung don't want to be at a competitive disadvantage. The rest also, the Infinix, the Techno, they don't want to be at a competitive disadvantage as well. You have to You have to continue to innovate. If I say this one is 5 now, the next thing I should bring another one. So how can we now resolve this problem now so that we will not be at a competitive disadvantage, even though our organization is big, the capital structure is what is large, the process is well automated, we have a good and skillful employee in their respective field, but there's no innovation. So how can we do this? Our managers are Our managers are very, very good. How can we solve this? It can establish a formal research and development function. Yes. So if you are not good, what you need to do now, have a separate functional area for R&D. So it's like a manager now, we are doing a certain delegation now. That we'll have a separate department, because if you have a research and development, so that means that you are giving this particular responsibility to this particular department to do to try as much as possible, do a market survey, look at how we can best design our product and the rest like that. So if your management are not good, they are not competent in innovation, how can you solve this risk? Because this is a strategic risk now. How can you solve this? Establish a formal research and development function, or a design team with a specific responsibility for developing a new product. It can acquire a successful entrepreneurship company. Yeah. And this one really happen in technology. It will be very, very difficult for to have a company now, whether it's in Europe, in Africa, to say that, I want to develop accounting software within let's say within a month or within a year. To develop if you can develop accounting software, ERP, for your HR, your production, your marketing, but to develop for accounting is a very, very difficult thing. Even all this Microsoft, what they will do is that they have to buy a successful company that have been doing that before for 20 years. So what they will not be doing is we just need to be building we need to be building on it. But for you to now say that I want to have accounting software, I want to build it from the beginning. It's a very, very difficult thing. It's the things that you can't even even in 10 years you can be on it. Because accounting is very, very it's very, very complex. If you say debit this one, it will go, you know how it will how it is going to split to different areas. So how do you now want to make sure that if I say click this button now, it will integrate other module? Is the tax. So what you can do in that area is acquire a successful company, then you build on it. It can also argue that a large manufacturing large companies need entrepreneur. An entrepreneur is a person with a large business entity who take a direct responsibility for converting a product idea into a profitable finished product by taking risks. It coordinates other factors of production as well. I'll take the risks, I'll give you the idea, and we always pray that it should be successful. So these are you can solve those problems, because you have to there has to be innovation in your organization. There has to be a good innovation. So how can you do it? Separate department, you can acquire, have a good entrepreneurial people in your organization. Companies should try to identify individuals who are capable of entrepreneur and give them authority and resources to innovate and take the risk. So delegate that. If I check your capability now, you are very good. So what I just need to do now is to delegate some activities to you that is this particular you are good in this. Then I will give you the responsibility that you do this. So in end product, what we are talking about, let me do this is a research and this is a research and development. It's a functional area of the world of organization. It's a very, very short, it's not really that big. So what are the reasons for innovation? Product renewal, product adaptation, developing a new product, developing we need to innovate as a result of new technology. So, and if organization fail to what? Innovate, it will be at a competitive disadvantage to its rivalry. Even though your capital base, you have a good employee, but if you lack innovation, that can make you not to be successful. You can be at a competitive disadvantage. So how can you now resolve this? Even though you have a good management team, you have a talented but management team, but they lack innovation. How can you solve this? Because this is a strategic risk. When we say a strategic risk, it's a risk that will not make our strategy to be successful. So that means that innovation can make our strategy not to be what? Not to be successful. So how can we now resolve this? Have a formal department. It can acquire what? A successful entrepreneur. Give what? Delegate authority to people that you know that they have a good capability of what? Doing a lot of innovation. Now the third one now, production strategy. This is a functional area as well. You can have a production department. Production strategy. Production strategy. And this one is mostly related, or sometimes we do not call it production strategy. And sometimes we also call it, what do we call it? We call it service strategy. We call it service strategy. In the manufacturer that we call it production. In the service organization, we call it service strategy. In a manufacturing company, the production strategy involves planning over the long term, how the company will be able to produce the output that will be needed to meet its plan for growth and product development. So you need to have a production strategy. Oh, I'm going to produce this. I'm going to produce that at this also date, at this also time. Oh, today we are producing 1,000 metric tons. Tomorrow we are producing this 2,000 metric tons. So you have to do you have to have a production strategy, so that you're able to meet the need of your growth. You're able to meet the need of your customer. Production resources planning. A manufacturing company must also plan to obtain the resources that will be needed each year. When we say production resources planning, in terms of this one has to do with for you to produce. It is not through the word of mouth. You need you need resources. So you also need to have a resources as well. That if I want to produce 1,000 metric tons, these are the inputs that I need. I need this. I need this particular chemical. I need this particular maybe you need ethanol, you need some of the chemical like that for you to produce. So you also have to have what we call production resources planning. And this one has to do with from the word resources. For you to produce, I need a certain resources. Oh, I need 10 labor. I need 10 kg of this particular chemical. I need this particular carton to package my goods after the production. Resources planning involve making the decision about which technology are we going to use. Is it going to be through labor? Or am I going to employ robots? So would I need a woman or a physical human being to be at the production floor? Or I need to use I need to use a robot. So that is those are decisions that production resources planning will try to make. How much capital would be it would be needed to provide the required capacity? How much capital equipment? How much capital equipment? In terms of your equipment, how much do you need? How much capital equipment will be need? Oh, I need I need maybe a particular what do they used to call this in production? These their machine, they have different different machine. So a production can say now, oh, by next year we should change our the machine that we are using. So we also need to be able to quantify that. Oh, how much capital? So as a production manager now, for you to be very successful, to make everything to be good, what the capital equipment do you think that you need? How much capital expenditure will be needed to acquire what? A new production equipment. In terms of what? Just like you want to buy a new one as well. How much is the what? How much do I need? What does it cost? How many production employees will be required? And what skills should they have? And this is very, very important. Oh, I need what? I need 10 employees. Okay, on what? Science student. I need someone that maybe you study what? Chemical engineering. Someone that study what? Biochemistry. So I need what? I need 10 of them. So if you say, oh, I need 10 employees, then you also need to tell us that of what skills? Of what? Of what skills? Oh, the skills, I need what? I need 15. Of what skills in terms of what? Oh, I need someone that study quantity survey. Oh, I need what? I need 2 accountants. Because accounting function in manufacturing is not really that, it's not really that much. Is the what? Is the science related things that they really do. Unless in a service organization. What material and component will be required, and where should they be obtained? Which particular supplier am I going to use? Which material am I going to use? You need to tell us. Oh, I need what? Ethanol. I need what? Alpha, beta. I need this particular one. And from where should you obtain it from? You have to tell us as well. And that's why some companies will try to be lobby with the production manager, because it's the one that will be what? That will say that, oh, I'm buying from this word, I'm buying from this, I'm going to buy from this supplier. So I need this material, and where should they be obtained? Where do you want to obtain it? Or some organization can split it where they will have a procurement department. So the production manager will only tell us that, oh, I need this particular component. You are not the one that will tell us that, we should buy it from this. That one is the work of the procurement department, and to now say, oh, this particular supplier, please supply us this. So it depends on the organizational structure. So what are some of the decisions that we need to make in production plan, resources planning? How many production, what production technology are we going to use? With development in robots, a company may need to plan for the introduction of new technology into the operation at some time in future. A lot of manufacturing companies in Europe are already doing it. How much capital equipment will be needed to provide the required capacity? How much capital expenditure will be needed to acquire a new production? How many employees and what skills? What material and component will be required, and where should we obtain it from? These are some of the decisions that in production resources planning we have to make. Okay. You also have to plan about the quantity, the quality, the lead time, and the feasibility. So organization, your production cost planning will cut across these 3 things. It will cut across your It will cut across your cost versus quality. Okay. And that's why let me flash us back to Bowman's strategic clock. Under the strategic clock is divided into 2 axes. We have the benefits, and we also have the price. So organization can also think that, oh, if my product, if the price is going to be low, if the price is low, then the benefit that the customer will accrue from there will also be low. Organization can determine that. Okay. So you have to think of the cost and the quality. And some organization can try, and that's why, even though it is very good, you can do you can increase your cost, but don't compromise the quality. Don't say because you want to achieve a cost leadership strategy, and your product is not going to be of good quality. If you are doing that, you are not going to be successful. So determine that oh, I'm using this strategy, and it is not going to compromise my what? It's not going to compromise my the price will not will not have anything to, or anything bad to say about the what, to say about the quality of it. And there are some organizations that will think that, oh, if I produce this one, oh, I will have different range. I will sell this one for what, for 15 naira. This one for what, for 15 naira. But the quality will be what? It will be low compared to the one that I'm selling at what? Compared to the one that I'm selling at what? 100 what? Compared to the one that I'm selling at 100 naira. Okay. So organization has to make this decision as well. In terms of your what? In terms of the cost can be possibly reduced by using a cheaper material, okay, to make a product, by using a cheaper unskilled labor to do some certain tasks. We usually say that labor can be divided into three. We have what we call skills, we have what we call semi-skills, and we also have what we call unskills. So you can determine that as well. To obtain a better quality output, it may be necessary to spend more. A decision should be made about the quality standard required for production output. Manager, you have to make this decision. And that's why some organizations, like I mentioned earlier, that they don't want to compromise quality. But my business environment in this country that I am now, the cost of production is very, very high. If you look at what company annual report, look at your organization, look at the amount that you're spending on electricity. So, and it's making it's making the production to be more expensive. And at the end, who is still going to what? I'm still going to charge it to the final consumer. So, and there are some consumers that are price sensitive. Now, when you see the product that is very high, what you try to be doing is that you'll be running away. But strategy is not meant to make everybody to be happy, right? So organization has to determine this, the cost and the quality of it. Cost versus quality. And another one has to do with the cost versus the lead time. Lead time is the time between receiving an order for item needed to make it and deliver it to the customer. When you say the lead time, in terms of the time it takes for me to order, and the time it will take for me to to receive the goods. Oh, I want to buy something online on Jumia now. So I order, and they will say in the next 3 days they are going to do they will deliver it. So the time it takes for order to receive the customer order the product, and the time it takes us to receive the goods, that's what we call the lead time. So an organization, you have to try as much as possible to do to reduce your lead time. Because one of the if you remember during the internal analysis, we talk about what customer need. What customer need? Customer need a good product, Abby, a quality product. Customer need a convenient Chinese, and that's why you have to have a good marketing strategy. A convenient Chinese. Customer also need what do we call it? A lead time, a reasonable lead time. And I can remember when I was young, there was a time that they ordered some fridge in the house then, and it's supposed to be delivered by Mega Plaza. That is supposed to bring the fridge. So I was on that Saturday. They said they will deliver the product. So they have to ask me to I have to stay in the house, so that when they because they want to see some document when they want to deliver, so that they will confirm that okay, I'm actually the right person that they need to deliver it. So I was waiting on throughout the Saturday. I can't leave the home because of they can come at any time there. And for almost 3 days, these people didn't come to do So, and that was my first experience I have when they say what, oh, they will deliver today. It's from what, Mega Plaza. So a customer need a what? A customer need a what? A better what, lead time. Try as much as possible to reduce your lead time, because if you are taking me a long period of time, I will look for another person. And another thing has to do with what, the flexibility. The flexibility is the ability to switch easily from one production operation to another. For example, to switch a production line from making one product to making a different product. Oh, if you are making component A, you have to develop your system in a way that it will make it it will make what we call it there has to be a flexibility in it, that we are doing component A before. If I ask you to do component B, you can also do it within the best possible period of time. So organization in your production, there has to be a flexibility. Flexibility in terms of, I'm working in the account department and I'm doing reconciliation. I'm the reconciliation officer. They have to develop the system in a way that even though the receivable officer is not around, you that you are doing reconciliation, you can easily ask you to go there. So organization has to make this decision in terms of your cost and your quality. Do you want to go for a low cost and you don't want to compromise you don't want to compromise the quality? You have to determine this. What are the cost and the lead time? The cost and the cost and the lead time. So you have to make this decision as well. So don't say because I'm charging the customer as low and the lead time will be the lead time will be high. So you have to make this decision as well. You are going to outsource your delivery, you can do that. Flexibility in terms of the ability to switch from one production operation to another within a good time. So you also need to look at the cost. If this particular department is producing component A and I'm asking you to produce component B now, is it possible for you to easily switch? And what is the cost of the switching cost? So that is production strategy, or sometimes we call it service strategy. Another strategy that we also have, we have what we call IT, information system and IT strategy. And this one will be as a good organization. If you remember during the corporate governance class, the IT strategy is the responsibility of the board of directors. Information and communication is one of the responsibility of the board of directors. That the information system that we are going to use in this organization, who will determine that is the board. So you need to have a good IT system as well. It's a very, very important. And protection of your the protection of your IT system against against any attack. Have a good backup. Disaster have a good disaster recovery plan. So every organization also needs to have a IT strategy. Don't see your IT department as a cost center. See them as a very important center that you have to take care of them. If the IT now they are submitting a certain payment voucher, that we want to buy this, and since almost a month now, you have not attended to them. That's not really good. So what are the main type of information system in in organization? To some of us that are doing performance management, this is also a revision to do now. Because this particular aspect, I think there's IT in PM. I don't know if they have removed it, but I think it's still there. There's the IT aspect. We have transaction processing system. These are system for processing routine transactions, such as your bookkeeping, your sales order processing system. Transaction from the transaction processing system. They are system for processing routine transaction. Transaction that always to occur every day. Management MIS. Management information management information system. Those are information systems for providing information mainly for what routine nature to management, so that they were able to make a good decision. Management information system. Those are information system for providing information mainly on routine in terms of what things that occur every day. The purpose of MIS is to provide management with information they need for planning and controlling. For planning and controlling. Typically, MIS is used to provide a control information for measuring actual performance against against budget. And I'm still referring you to your performance management now. There are some topics, there are some topics that is for planning. We call it planning and control. There are some topics that it is for decision making. Like maybe your make or buy now, deleting the segment. Those are decision making stuff. Your variance analysis now is a planning and controlling tool. So if you calculate it, for example, now if you go for inventory count now, okay, the inventory count is already computed, okay, which we know. The next thing is that let's put it in the system, and the system will do the main reason why once you do a physical inventory count, the next thing we'll do is let's incorporate it with what we have in the system. Then so that we're able to calculate the system will calculate a variance analysis. We have a variance analysis report. Then we do then it is now meant for investigation and control will not take place now. Now what lead to the variance? So MIS is providing information to management for routine, and for it is for majorly for planning and controlling the organization. We also have a system called DSS. Decision support system. A decision support system is used by manager to help them to make a decision of a complex or unstructured nature. A decision support system is used by manager to help them to make a decision of a more complex or unstructured nature. You can see now in MIS now, it is in terms of it is things that it will occur everywhere. It's occur every day. It is not it is not something that it occur everywhere. It's something that occur every day, just like your working capital. It's a thing that is a routine. But information system for all routine or unstructured, that's what we call decision support. Is to make we provide this information to manager to make a decision of a more complex or unstructured nature. Unstructured nature in terms of maybe that particular transaction it has not occurred before. That is DSS. A DSS will provide will include a range of decision model, such as forecasting, analysis, statistical analysis model, your linear programming model to managers. But those decisions that we provide the manager using decision support system are something that they are not routine, they are more complex, or sometimes we refer to it as they are unstructured in terms of we don't really know is like a dynamic structure in terms of it can go different way within just like what we call unplanned and what we call unplanned chain. Something that we didn't plan for, is something that it doesn't occur every day. Executive EIS, executive information system. An executive information system an information system for what? For senior executive. It give an executive access to key data at any time, from source both within and what? Outside. Can executive can use executive information system to obtain what? Summary of information about a range of issue, and also what? To drill down into a greater detail if that is what is required. Just like what you are providing a what? Executive what? From the, let's just say executive summary. You are writing a what? You are writing a report now, and you provide a what? Executive summary. So my executive summary now should be able to what? Should be able to capture the what? Should be able to capture everything that I've what in the entire report. So just like you're writing a what? A business plan now. A business plan can have different what? Can have different sections. But I'm going to have a what? The first section in my what? A business plan should be the what? The executive summary. So that even though you do not have the time to read the entire report, once I see your what? The executive summary, you should be able to give me a what? A guide. You should be able to give me the true picture about the what? About the entire report. Just like in what? In the summarized way. We also have what we call what? Expert what? Expert system. An expert system is a system that is able to provide information, advice, and what? Recommendation on matters related to a what? A specific area of expertise. For example, there are what? Expert system for medical analysis, law, and taxation, used by mainly what? Maybe a doctor, solicitors, what? Or accountant. For example, now if I'm providing a what? Let's say if I'm providing information about what? Let's say as an accountant, and I'm providing information about how we calculate variance analysis, or we are calculating what? A break-even point. A manager may not what? May not really understand that. But as an accountant and as an expert, as a professional, who understand that, oh, this is what? This is a break-even point. This is what? This is a graph. So if our sales fall below this, this will be the what? This will be the result. So to like a what? Someone that studied biochemistry now may not really, is not going to understand that. So those information now in a graph now, or I'm providing a what? A linear programming what? Information now. That one is to what? To expert. A diagnostic what? Information, and that is to what? That's to the doctor. That, oh, go and conduct what? X-ray now. As an accountant, I don't really what? I can't really determine that, oh, what really happened. That one, that is the what? Example of what? Expert information. That, oh, it's not meant for me. I don't understand it. So is the what? Is the doctor that what? That will do that. So if I'm also presenting a what? This thing now, a break-even point analysis what? Graph now, it's me that we're able to what? So if someone sell me the what? That particular report, I understand it. So expert system is the what? Is a system that's what? That provide information, advice, and what? Recommendation on matters related to what? A specific area of what? Of expertise. Expert system for like what? The medical doctor, as an accountant as well. So these are majorly what we have in what? In IT strategy. Just to talk about what? Different information system. Different information system. And this is just what? This is just 5. Functional strategy is not really a big topic like that. And this has not been what? I have not seen any question here before, honestly. Under what? Functional. Most questions usually between what? Corporate and what? Usually between corporate and business what? Or corporate and business strategy. So now let me what we just need, what we are left with. Okay, let me explain what. Let me explain HR. HR is not really that big. Then we'll have what? I'll do a brief recap of some of the things that we have talked about. Okay. Then is the one that is a little bit long is the marketing what? Is the marketing strategy. So we have what we call the HR. HR. And this is a very important functional area in every organization, because this particular functional area deal with the most important asset of every organization, which is what? Your intellectual capital, your human resources, people that work for you. They are the most important assets of every organization. So you are have to what? You have to take care of them. So, and we need to have a good what HR is really about is about the recruitment, it's about the performance appraisal, training and development, and motivation as well. They have to put some incentive in place so that we're able to motivate the employee. Because for us to achieve a competitive advantage, that's the essence, that's the main reason, that's the thing that we are talking about in strategic management, is about to achieve a competitive advantage. So for you to achieve a competitive advantage, your employee also have something to say about that. If a company is successful and the one that is not successful, your employee have something to say about it. Or if I say that, oh, this organization is very, very good, okay? And I say that, oh, this one is not good. One of the reasons why you'll be good or be bad is your employee. So organizations should try as much as possible to reduce their labor turnover. That is what we usually advise a human resources manager as well. That, oh, if you receive a recommendation that, oh, this employee said that, oh, I'm resigning, we have to be looking at what really happened. Why? What is going on? And as the HR, we have to try as much as possible to reduce our labor turnover. People should not just be living anyhow. And that's why we have some managers that believe that, oh, if one go, I'll see another one. Yes, you see another one. Especially in the current environment like this, where the active population is much. But before you see another one, even though you see another one before the new one that you just recruit now, before you to adapt to the system, it will take a time. And that's why I think in the banking, what they usually do is that even though before you go to the branch, they will also, what they will do is that they could have provided you with maybe a training, or I think the bank do that. They have they have a training school that you first maybe some 2 months you spend there before you now go to this particular branch, so that you're able to before you go to the branch, it's not just that, oh, you are like a novice now. So before you go at the operation, and then you could have known, oh, this is what I'm. So if I go to this branch and if I'm posted to here, I know what exactly I'm going to do. So not just that I will just resume, then you now start you not just, oh, this is how you're going to do it. No. So the objective of what HR strategy, responsibility of HR management is to do what is your responsibility? Assess the quantity and the quality of human resources currently available, including the number and the skills. We are talking about quantity. Quantity has to do with the numbers. Quality has to do with the skills. Just like in audit, we usually say appropriateness, and we usually say sufficiency. Appropriateness has to do with the quality, that as auditor, I should be able to generate enough evidence, a sufficient evidence that the evidence should be much. But the appropriateness has to do with the quality of it, the reliability of it. So it's not just about having a large employee. That's you have the large numbers of employees, but they are not really working. The quality is not there. The performance is still low. So we can see now that the quality supersede the quantity. You can only have 2 cars now, and they are of good quality. It's better than having 5 now, and they are not of good quality. The appropriateness supersede the sufficiency. The quality supersede the quantity. So the HR has to determine this. How many employees do we have, and what skills? The one that require training, give them a training. Estimate the quantity and the quality of HR that will be needed in the future. We are looking about look at this now. Currently currently available, and you're also looking about the future. How many do I have now, and of what skills? Then how many I need in the future, and of what skill as well. So HR has to determine this. Consider what? So once you determine the what, oh, I have 10 now, and this is their skills. So how many did I need in the future? So I need what? I need 50, I need 30. And of what skills? So now we can see now there's a gap now between the what we have now and what we are hoping to have in the what in the future. So you have to find a way now of what's closing the gap. So that means that you have to recruit what more employee now. Consider a way of what filling the gap and ensuring that the entity has the resources that you need. The objective of what HR strategy is to ensure that human resources are as available as required. I should have a good number of employees that are available and of good skills. In some scales, it might be necessary to consider reducing the number of employees which skill are at decline. And that's why every organization, you have to try as much as possible. Give your employee training. You can't provide him maybe on the job or off the job. Then you have to sponsor that particular one. Okay, go for your ICAN exam. So that if there's a certain deficiency now, it should be they should cover that. And they will be the one that will pay. Or they can send you to go to some seminar, learn, then you come back. And I think in public sector, there's what we call this, there's one advance for I think we call it correspondence advance. So that one is an advance that we give to employee for educational for educational purpose. We call it correspondence advance, if I can remember. So we have motor vehicle, we have motorcycle, they are still using it now. I don't know. So what are the main as a HR now? You have to plan. You have to plan as well. A good planning is also required. So you have 4 main, but it can be extended to 4 that human resources planning will cover. 1, study the corporate objective of the entity and the strategic objective of each division and department. This analysis should be used to estimate the likely total size and the organization structure of the entity. What we are saying here is that for you to plan your HR strategy very well, what you need to do is understand the organization structure, so that you know the total size of employee that in this organization structure, this organization organogram now, I need 50. So these are each functional area: accounting, the finance, the production, the R&D, the IT, something, all the rest like that. Then you are able to determine the total size that in this organization structure now, to make this organization structure to be effective, how many employee is required. Total HR number should be consistent with the corporate and divisional strategy. In terms of you don't just have many employees that they are not working. It has to be inconsistent with the corporate objective and the divisional objective. If we need in this division, I need 30. Provide 30. So not just you are just providing the number, maybe, or you are just employing people because they come from your geographical location as well. No. Demand forecasting. The required numbers and the skills of human resources should be estimated. Now, just like how many do I need in the future and of what skills? So the required numbers and the skills should be estimated. By 2020, by 2025, maybe I'm going to need I'm going to need 30. So you're able to do some estimate of the numbers and the skills that you need. Assign the current resources. Assessment should be made of the current human resources and what happened to those existing resources each year over the forecasted period. And here, that's what you have to be thinking of How many what? How many employee do you consider that is going to leave? So as HR as well, we also need to have it at the back of your mind that, oh, in this current organization, how many employees do we consider to what? Oh, that we need to determine the neighbor turnover as well. That, oh, maybe during the year I expect maybe 5, or I expect, depend on the organization structure. So assess the current resources, assess the current manpower that you have. The assignment should allow for expected wastage, or we call it expected neighbor turnover rate. So that we ourselves, we should be able to have it at the back of the mind. Oh, we expected we expected 10. Maybe we should expected maybe 5% neighbor turnover. So assess the current resources. So when you are assessing the current resources, you're able to know the words. Oh, these are what I have now, and these are what I think that we need. So that I will able to plan for the world. I will able to have plan for the future as well. And there are some industry where their neighbor turnover is usually very, very It's usually very, very high. Prepare a policy and plan. The final stage in the planning cycle is to develop a policy and plan to fill the gap between the required numbers and the current focus for the future. Oh, I need this now. These are what I have now, and these are what I'm planning for the future. So you have to prepare a policy and plan for that. So those plans will include the recruitment of new employee, the training that you need to give the existing one as well. Performing performance appraiser to monitor and control the development of skills, the one that require promotion, the redundancy, where some employee will be surplus to requirements, or that will require retraining. So you have to develop a policy and plan. So your policy and plan will cover now? Recruitment of new employee and training, and that's one of the core function of HR: recruitment, training and development, performance appraiser, promotion, and redundancy. Every HR have this, and HR also have motivation as well. So there should be motivation in terms of incentive package, so that employee will be able to perform very well. And there's another very important thing in HR, and that's sometimes we call it what do we call this? Knowledge management. And there are some organizations that will have a separate department apart from HR. In the olden days, HR is they usually refer them to personnel department. But now, as the world is moving on, we have what we call the HR, and nowadays we have what we call the knowledge department. So this one is just like a separate aspect of HR, knowledge management. It is very, very important. So it is this particular department that will be monitoring in account department, how many chartered accountants do we have? Oh, they are 10. We have 15 in the finance. So how many of them are chartered accountant? Oh, yeah, we have 10 of them. So what about the remaining 5? Oh, maybe they are also they are writing their exam as well. So it is this particular department, knowledge department, that will be looking at the gap in terms of the knowledge that for you to perform. In this particular department now, how many training have we provided for them during the year? So some organizations have what we call knowledge departments. The plan should be realistic, and therefore take into consideration of the environmental factors as well. So if you are developing your HR plan based on the current assessment that you have made, and the performance in the future as well, you should be able to do you should be able to look about your try as much as possible to take your environment into consideration as well. The plan should be realistic, and therefore take into consideration the environmental factors, changes in population trend, and the total size of the workforce in each country where the entity has its operation, changes in government policy, such as changes in retirement age. Maybe you have you increase from 70 to you have reduced it to 65 now. So if I expect this one to retire at, well, okay, maybe the retirement age before is what is 70, but it has, there's now a legislation now that has reduced it to what, to 60 or 65. So that means that it will also affect the what, the HR plan as well. So try as much as possible that when you are developing your plan to what, to take care of the what, the current and the future, look about the what, look about if there's any changes in what, in government legislation. And I think during the President Muhammad right now, they changed the what, the retirement age for what, for some of teachers. I can't remember. But there's a changes in one retirement age for certain workers in Nigeria now. Changes in what, in educational system, and the numbers of what students going from school to further education. And in Nigeria, I think if you look at the what, there's a certain report, which I think I shared the what, the video to you, that what, is it not 8% in Nigeria, that is out of what, if what, let's say for example now 100 students now, we started what, primary, is only what, out of these 100 now, it is only 8% that what, that will finish university. So that means that what, now we have like a what, more than 90% people that are what, that are dropouts. So if 100% start what, primary school, and 8% of them graduated, you can see there's a problem in that economy, a big problem. So the educational system as well, when you're planning your what, your HR policy and plan, take all these things into consideration. The availability of what, individual who are trained in a particular skills or vocation. Are they really available? They are okay. So if I'm what, if I'm say, oh, let me introduce some robot now. Did I have the what, the particular individual in this my current what, economy, that have what, that have training about that particular aspect, that have the skills? So as you are developing your what, your production, as you are what, as you are planning your HR or your work activities, or if you are introducing a new work system, you have to be looking at what, did I have the required resources? Did I have the required manpower? Competition for what, HR resources, okay, sorry, changing what pattern of what, employment, possible what, increasing the number of what, part-time workers or what, or home workers. These are what government legislation as well that can increase HR, that can affect our HR policy. Competition for what, human resources from competitors and other business. So contracting and outsourcing, training in what, in IT and what, technology. So when you are developing your what, if you are developing your HR, your human resources plan and policy, make it to be realistic and take your plan, your policy, take some of these factors into what, into consideration. So the final one, final functional area, we are only looking about what, 6, looking at the finance, the production, the research and development, the IT, the HR, and the marketing. And what we are just talking about in the marketing is just the what, the marketing mix strategy. The marketing mix strategy. And if you remember during the internal analysis, we talk about what as well? We talk about 4P. The 4P of marketing, we have the product, the price, the place, and we also have the what? We have the promotion. So what we now be talking about is that what? So each of these 4 now, we need to have the what? A separate what? A separate strategy for them. A product strategy now, what are the concern of the word of a product strategy? The product strategy will be considered about the what? Designing a new product, okay? How are we going to design the product? How is the product going to look at? How is it going to look? Design the new variation of what existing product to set into a different market. In terms of what your product strategy can also be different depending on the location. In terms of where are you selling this product? If you are selling to Africa, you may have different product strategy. We are selling to Europe, we can have a different product strategy. Another thing that you also need to have consideration for is the actual and the perceived future of a product, a very, very important element in the marketing mix. The future of the product, and that's why innovation also comes in now. The design, which color are we going to use? Which future are we going to add to it? Your production strategy should be able to take this into consideration. Product strategy is concerned with what the design of the product, the variation to the existing one, maybe in different location, in different markets, the actual and the perceived future of the product. Feature of a product design, to look about this function, what that particular product, what is it serving? Why do you have to buy it? We need to ask ourselves this. The comfort, the conveniency, the quality of the material, the useful life. Like if you buy this product now, what is the word? How many years? The durability, the reliability, the quality of it. If you buy it now, you can see it for maybe for the next 10 years. The safety as well. If you buy this particular product, it should be harmless. The packaging. So these are future, these are characteristics that when you are designing your product, you should have them at the back of your mind. These are characteristics of a product design. That when you are designing your product, when you want to launch your product, you should be able to ask yourself this type of question. What is it? What is this serving? What is the function? The comfort, the convenience, the quality of his material, the useful life, the safety, the uniqueness, and the packaging. The price, and this is a very, very important aspect, the price. Because even though your product is good, you have a good product, it's fine. The strategy is good, it's convenient, it's not going to harm, it's very reliable. It's not the one that you buy today and tomorrow you'll be thinking of buying another one. So you have to think about the price as well. Once you develop a good product, you have to think about the price. And we have we have different price strategy. We have what we call market penetration. We have what we call penetration strategy. Let me just go to the pricing strategy. Market penetration strategy. Market penetration strategy is from the word penetration, meaning that word I will enter. I want to penetrate the market. I will enter the market with a low price initially. For the product, this is the low price or a fairly low price. The aim of penetration pricing is to build a customer demand quickly by offering attractive price, so that the sales volume is high, and the company penetrate the market and win. But this strategy is not a strategy that will use for a long period of time. What I just want to use this strategy for is for me to just build the market, build the brand. Let people know that I am present. I just want to do what? I just want to penetrate the world. I just want to penetrate the market. Maybe it can be it can be a new product. It can be a new product. That, this is a new product. Now I've designed the product very well, but I want to take the product to the market now. I want to determine the price. So before we send the product out now, our price is 1,000. We have to try as much as possible to be careful about the price. Even though the product is good, if the price is if the price is not, sometimes if the price is high, it may not really make the product to be successful. So we can have what we call what market penetration, meaning that what we want to penetrate the market, we are going into the market with the what initially at a low price. Then we also have another pricing strategy. When we say what market scheming, this is a high price. The aim of what market scheming is to maximize the gross profit per unit sold. Gradually, the price will be reduced, and the market demand will be the market demand will raise slowly as the price will fall. But if I want to go initially now, the price will be the price will be high. So just like there are some phone now that, let's say for example now, if this phone was released, the price was to go up. So it is only once like 10 people have purchased the product, is already covered my production cost. So later in the long run, I can now start be reducing the price small, and entirely maybe in the long run I'll withdraw the product from the market. So market scheming is that initially the price will increase. But as we are moving on, the price can now be the price can now be coming down. The price can now be the price can now be coming down. So these are the two pricing strategies that was mentioned in our syllabus. But we also have another pricing strategy. We have what we call value-based pricing. It's another pricing strategy. But the most popular one is penetration and scheming. But in marketing, we also have what we call value-based pricing. You can also note this down. Value-based pricing. And value-based pricing is a higher price is due to some additional feature that is associated with that goods or service. So if I'm providing additional service, if I'm adding additional value to that product or service, then the price will also do what? The price will also increase. For example, now if I just the product now is 1,000 and you buy it, but if I'm the one that will do the installation, the price will not be the same. That is what we call value-based pricing. In terms of you buy the product 1,000 naira, you take it to your house and you install it by yourself. But if you want me to do if you want me to do the installation, the price will not be the same. So if it is 1,000 naira, you take it home, you install it by yourself. Then if I want to do if I'm the one that I'll deliver it to you, and I'll also do I'll also do the installation. So the price will change. That's what we call value-based pricing. Value-based pricing. In terms of or for example, now you want to buy something online now. I'll come and pick it up by myself. But if you want me to deliver it to your doorstep, the price will also change. And in accounting, we are going to do we'll capitalize all direct costs, like the transportation now, directly attributable costs now, the installation cost. I also capitalize it to the part of the so if the purchase price is 1,000 naira in the invoice, but I also need to add the delivery. So the price is not actually just that 1,000 naira. I also need to capitalize all directly attributable costs. So that's what we call value-based pricing. And another one, let me also tell you, there are 5 which I can still remember them. We have what we call incentive-based pricing. We have what we call incentive-based pricing. Incentive-based pricing. And this is a pricing that we adopted if we pay upfront. This is a pricing that we adopted if a certain customer pay upfront. That if you pay us upfront now, the price that we are going to adopt. So I can say that if you pay upfront now, you pay 9,000 naira. And ACCA have that thing. I think ICAN doesn't have on this incentive-based pricing. ACCA have it. And most of international exam, they have, most of them have upfront, they use what, incentive based, meaning that if you pay upfront, for example, now I think the registration for ICAN maybe to close by the end of this month or in the next month. So and the registration can be hard since like maybe 3 months ago. So if you now do what now, let's say for example now, a week between when the registration comes and you register, they can give you you should pay maybe like 3% reduction. That's what we call incentive-based pricing. That if you pay upfront, even maybe before we deliver the goods to you or before the production starts, you already send us some cash. Then we can reduce the price for you. And the last one is what we call competitive pricing. Competitive pricing in terms of what I'm going to charge price that my competitor is also charging. If my competitor is charging 1,000, I'll also ask you to I'll also charge 1,000 to you as well. So pricing strategy, what you have here is what we call penetration and scheming. We also have what we call value-based pricing. We have what we call incentive-based pricing. And we also have what we call competitive pricing. We also have what we call the place strategy in terms of where you get the product, the channels of distribution that we are going to use. And as organization, we also try as much as possible to make the channels of distribution to be convenient to the customer. Convenient channels, a place that if you go to this particular place now, you see our product there. Make the channels of distribution to be more convenient to the customer. That's what we call the place in terms of where do you get the product. We also have the last one, which is what we call promotion strategy. Promotion strategy, just like advert, in terms of how are we going to make the customer to be aware of the product. How are we going to make you to be aware of the product? We have adverts. We can do advert maybe on the television, on the billboard. Sales promotion. Activities other than adverts that are designed to promote customer into buying the product. In the supermarket, the promotion are often placed at the end of the line of the shelf or the checkout. For example, buy one, get one free. Direct selling, in terms of I think I was traveling one day. I was traveling to Bayelsa, and maybe it was someone that was I think is a musician, and he's trying to market the product that I should buy a CD. So you might just look at me like, my son, I know that you may not have the time to listen, but just support me. So you can see now what he's doing now is direct selling. No, I am the one that produced the album that this is my song and something like that. But I'm the one that's also selling it by myself as well. I'm not having any middleman. So you can also do direct selling, or sometimes we call it personal selling. Sponsorship as well is also another way of getting your product to be known. Sponsorship. Well, okay, if there's ICAN is doing a particular event now, or they are doing induction, you can do you can ask them to do some to do some promotion where you pay them some fees as well. So those are another way you can also get your public promotion. In terms of if there's a particular event, you also be there. So these are various ways you can make our product to be known to the customer, so that the customer will know about our product. It's a way of creating awareness. Advert, sales promotion, you can do direct selling, sponsorship, and public. So, and we have another two strategies. We also have what we call there's what we call push strategy and pull. Push and pull. We have pull, and we also have what we call push strategy. And this is a subset of production promotion strategy. We also have what we call push strategy, and we also have what we call push. Push strategy now is aiming at getting distributor to buy the product for resale in the supermarket or other retail. Meaning that I'm pushing the product to you, just like a newspaper now. I'll push the product to the to the distributor to get the product sales. The aim of push the product through the distributor is to end the consumer. So that now the consumer will not be, if you want to buy a newspaper now, you can't go to to maybe Punch now or Sun that, you want to go to their office, you want to buy a newspaper. I don't think they are not doing that. They are doing a push strategy where you give it to a distributor. Is a distributor, the vendor that you can be buying, you can get the newspaper from, not from us. That is what we call a push strategy. We are pushing the product to the distributor, to the vendor. The vendor buy the product and sell it to the consumer. So we are eliminating the consumer now from coming. Then the second one is what we call pull. Pull strategy is aiming at getting the end consumer to want to buy the product, so that they expect their supermarket or other retail store to have the product available. If consumer demand the product, distributor will be more willing to stock it because they will expect to sell it easily. Adverts and sales promotion are very important in pull. In pull, the aim is getting the end consumer to want the product or the service. So before I will do now, just like maybe before I will have it now, you have to there has to be a certain demand for it. And this particular strategy have a characteristics of JIT. There's what we JIT, just in time. JIT is divided into two. There's what we call purchasing and there's what we call production. In production is that I will only produce if I receive order. If I did not receive order, I'm not going to produce. So when the customer demand for the product, then I can now ask people to supply me. People are they are demanding for this size of shoe, they are demanding for this type of product. That is a pull strategy. The aim is to getting the end consumer to want to buy the product, so that they expect the supermarket or the retail store to have them available. But before we're able to do some of these things to be successful, there has to be some survey that, okay, let's just first study the market first. Let's see if people want. So if I purchase 10 and within a couple of time, everything has been sold and people are demanding for it, then I can now be procurement. So rather than because there are sometimes if you have a product, a large quantity, you may not see a customer that will demand for it. So this is the end of this is the end of functional strategy. Functional strategy. And what we are just talking about is just about the functional area of organization. We have the finance, we have the production, the research, the HR, the IT. So now let me please give me a few minutes. Let me open the question I sent, so that that will give us a task. I want us to calculate calculate the ratio. Then this is the last aspect of strategic management. So what I want us to do now, please calculate the ratio. You can check your financial reporting, calculate the ratio. So when you now calculate the ratio during the next class, then I will do the analysis. So what you just do now, when you want to analyze financial, we use ratio. So the ratio is already provided, and I think is provided. You are provided with ratio to calculate it. But one of the things that you have to do, that the examiner wants you to do here, is that you need to first of all tell us. You need to categorize the ratio, whether this one is whether this one is profitability ratio, whether this one is short term, whether this one is investor. So please, what you do, calculate the what, calculate the ratio. So once you calculate the what, once you calculate the ratio, then don't worry, we'll do the what, we'll do the analysis. And please, for everything, whether it's what, it's only what taxation that I'm not aware of. But for everything, and what in the 6 papers that you have at skills level, at 5 of them there's ratio analysis. So this is a what I hope every one of us you can see this question now. This is a question that under what financial strategy, and under one of the tools that we use in financial strategy is to conduct a ratio analysis. So you can be presented with a financial statement just like this. Then we'll ask you to do what? We'll ask you to analyze the financial statement. And I'm telling you, before you analyze a financial statement, one of the things that you should do is for you to please try as much as possible to study the financial statement first. Try as much as possible to study the financial statement. If you study the financial statement, and just like just an accountant, you should be able to analyze a financial statement without doing without pressing calculator. You should be able to know whether this company is performing better or is not performing better. Look at 2015 now. Look at 2016. Our gross profit last year is 200. Now it is 150. So that means there have been, before I even calculate a gross profit margin now, you need to have it at the back of your mind that, gross profit margin of last year, it will be better than this year. You need to have that. So before you do calculator now, before you start pressing on, you need to be able to tell us that, what's the financial performance? Is last year better than this year? Is our performance better than our competitors? Because you can analyze financial statement in 3 ways. I can analyze with competitors, that's one. I can analyze with industry as well. Then we can also analyze with the last year as well. And we can also analyze with budget and actual. So that's just like a 4-way you can analyze. And so this one is still within the same company. We're giving last year, and you're also giving this year as well. So last year we have a profit of profit after tax of 124, but this year it is 50. Okay. So now look at the additional information now, because when you want to analyze now, we have to analyze in context of business strategy. So now look at the additional information now. I said the managing director is of view that the company has retained its book value and therefore has not suffered any deterioration in performance from 2016 to from 2015 to 16. So the MD is telling us now that our performance is not really bad. It's not really bad. This statement was made in the process of appraising a new strategy introduced by the company, which believe has not failed. You can see now there's element of strategy now, and that's our concern. That they are introducing a new strategy now. What is not the new strategy that they are introducing? Odua PLC has a traditional been profitable, that's good. But in recent years, has been finding it difficult to keep the sales level due to the effect of online You can see now. So that means I'm finding it difficult to keep my sales due to there's a reason. Because this company, we are told that they have been a good company before. But the reason why I'm turning not to be profitable now is as a result of this online shopping now. Okay? Basically, it's fine that there are more customers are buying directly online from supplier and cutting out the middlemen, which include Odua wholesalers. So you can see where the problem is coming from now. That's our profitability. To cope with this, okay? On January 1, 2016, Odua launched a strategy of cutting his price in hope that this could generate additional sales and volume. So let me now also hear from us now. Which strategy is this company trying to adopt now? Because you want to analyze now based on based on strategy now. So which strategy do you think that they are trying to introduce now? Is anyone? I said to cope with this situation, on January 1, 2016, Odua launched a strategy of cutting its price in the hope that this could generate additional sales volume and profit. So I'm now asking now that which strategy is this organization asking? Let me make it
market
easy.
penetration.
Market penetration. Okay, that's good.
I may be wrong, but I think so.
Yeah, yes, it's fine. Market
So that at least
market
they can attract demand, attract more level of demand. Yes.
Yeah, yes. Thanks. That means
Price
that price
strategy.
strategy is what? Price strategy, yes. Thanks. A price strategy, yes. In terms of what? Cutting our what? So you can ask what? You can now choose now that, okay, is it penetration? Is it what? Is it skimming? Or I still mention another three for you, which is what I have what we call value-based pricing, incentive-based pricing, and we also have what we call what competitive what pricing. So that means that this company now is what there's it changes in what in pricing now. To cope with this situation, on January 1, we launch a what? We launch a new strategy of cutting is what is price. And you can even think it was what thank you everyone. What you said is what is correct. There's been a price strategy now. In terms of what penetration, right? Maybe they are cutting, they are trying as much as possible to have what a low price now. What online this thing has making it what they make it difficult for them to maintain their profitability. And if you look at it from the angles of what maybe Porter generic strategy, maybe that they are trying to use what we call what now cost leadership, what cost leadership strategy. Okay, thanks very much. Now look at additional information 3 now. They said to support the new strategy and allow a faster movement of goods, a new product movement and control system was commissioned and installed on January 1, 2016 at a cost of what? 40 million. Wow, that's good. This is being depreciated over what 5 years economic life. The old system was what was disposed of for zero consideration on the same day. Why? But had a carrying amount of what 15 on that date. This is a bad manager. Look at what happened here. The old system was disposed of. Okay, so that means that you have a new one, and the new one that you have on January 1, 2016, it costs what 40 million. And the old one that you're using before, the carrying amount is still maintained at what 15. And you are told that what you are told that you dispose this at what at 0, and that is bad. So that means that we didn't have any we didn't generate any return from something of what 15 million. And that's why in audit now we have to take this up. So let's calculate the materiality. The losses was taken to what? To cost of sales. So that means that the cost of sales could have been what? So that means that because this is like a loss now, because if I credit a PPE account now with what? With the current amount, which is 15. I'll credit PPE account, then I will do what? I will debit disposal. Then if I debit disposal account, I also need to do what? It also needs to have a credit entry now. So that we're able to determine whether there's a profit on this. So that means that there's a what now? This is like a loss now because something that costs what? So that means that we debit the disposal account with like a 0 now because there's no any what? We didn't have any return. And we are told that the loss now has been what? Has been carried to what? To cost of sales. So maybe the reason why the cost of sales is what is going off now is as a result of these losses. No other non-current assets were acquired or disposed of during the year, and we are also giving their share price. I also say that their share price has declined from 2 naira 80 kobo per share on 31st of to 1.1 naira 6. So this and the reason why. So what the examiner asks you to do here now. First of all, you need to do what? First of all, you need to analyze this financial statement, and you need to analyze, but you have to have additional work now. And I want you to please, even though you are not doing FR, check their pack for this. But let me tell you, there's no need of stressing yourself about that. What you can just stress yourself now is to get the formula. What the examiner is asking you here now is that analyze the financial performance of by evaluating and interpreting the underlisted ratio under relevant heading of profitability, efficiency, short-term, liquidity, and long-term was solvency, as well as what? Market performance. So the examiner is asking you to do now that, oh, this ratio that you are provided now, gross margin, net profit, I want you to categorize it into what? 4. You categorize it into what? Profitability, that's 1. You will now categorize what? Efficiency, 1. 2, short-term liquidity, long-term as well. Then you also calculate what? Market. So that means that you are doing 5 things now. So let me now tell you now. You see what? Gross profit margin. This is a what? A profitability ratio. Net profit margin is a what? Is a profitability ratio. Return on capital employed is a what? Is a profitability ratio. Return on equity is a profitability ratio. These are 4 profitability now. So under profitability now, you should calculate these 4 ratios. Gross profit margin, net profit, return on capital employed, return on equity. Then for what? For short-term liquidity. For short-term liquidity, this is what? Current ratio. And we also have what? Acid test.
Yeah.
These are what? Let me change the color so that it's going to be easy. So for what? Short-term liquidity, current ratio, and acid test. For what? For efficiency. This is what? Inventory days is efficiency. And please use 365 days. No, okay, it's already mentioned, sir. Inventory days. You're going to use what? You multiply with what? 360. Receivable. And we also have what? Payable. These are what? Efficiency what? These are efficiency ratio. We also have another one called what? EPS. EPS is a what? Is a market ratio, or sometimes we call it what? Shareholders what? Let me change the color so that it's easy. We call it what? Shareholders ratio. Price earning ratio is also a what? Is also a what? A market ratio. Gearing ratio is a what? Is a solvency ratio. Let me change the color. And what? And interest cover as well. Interest cover is also a what? Is also a long-term solvency what? Solvency ratio. So the task now that I'm giving you now is what? Calculate the what? The ratio. I've done the what? The categorization now. For profitability now, you have to these are the 4 ratios: gross profit margin, net profit, return on capital employed, and use the what? Return on equity. For what? For efficiency, we have what? Inventory days, payable days, and what? Receivable days. These are efficiency ratio. For short-term liquidity, we have what? Current ratio, acid test ratio. For what? For long-term solvency and stability, we have gearing, and we also have what? Interest cover. And the market ratio is just 2: EPS and the what? Price earning ratio. So calculate the what? Calculate the ratio now. During the next class, I will show you how you do what? The interpretation of what? Of financial what? Financial statement. So these are about what? These are about financial what? Strategy. And for us to appraise financial performance, we use what? Ratio analysis. And I'm telling you that this company, if you analyze, just calculate the ratio. And before you even calculate it at your leisure time, just try as much as possible. So please, whenever you are provided with financial statement, whether in your exam or during at your workplace, the next thing that you have to do is for you to please try as much as possible to understand the financial data that you are given. Because if you understand, look at last year now, 2015. Look at what this year as well. If you look at the data that is provided, you yourself, you are going to determine that whether last year is better or this year is what is better. So before you start pressing your calculator now, what you need to do is what? Study the financial statement first. So that once you what? You have it at the back of your mind, oh, last year is what? This year is bad. Last year is better. So that means that the ratio that you also calculated now, this year is going to be what? This year. And for example, now before I'm going to calculate, I'm going to know that, oh, gross profit margin is going to reduce. Because last year it was what? It was 200. Last year is 200, and this year is what? Is 150. So that automatically my what? My gross profit margin it will drop. Okay. So please calculate the ratio and what you can send it. Maybe if you are done, or you can keep it to what, to the next class. There's no problem about it. Then I'll do some analysis for it in contents of what, in contents of business strategy. So let's see now whether the strategy that they have introduced, whether it's what is not bad or whether it's good. Because what the MD, you just need to we need to write a statement about what this MD is trying to say in terms of what you can see, saying that what the manager director is on the view that the company has retained its book value and therefore has not suffered any deterioration in performance. So that means that he's still saying that, oh, well, the performance of what 2015 compared to what is sustained, there's not really there's not something bad about it. So let's check that as well. Okay. So my people, thank you very much. And sorry for starting the class early. So sorry for starting the class late. So this is the end of what the strategic management aspect. And let me tell you something before you go. What you need to do in strategic you see, let me tell you something about this course. To make this to make your passing very not really stressful, you have one of the area that you have to be very good at is you have to focus on area that is not really much, but question is usually very coming out from you every day, which is what is the risk management. Okay, risk management, every diet. If you check last diet now, question that was tested from risk management is what is a 35 mark, and which is on what, which is just 2 chapters. And if you look at the note that I sent to you, so don't worry, if I'm doing a revision class, I also have the summary note that just contain what, just like an 8-page, and it contains everything in risk management. So you have to read risk very well. And I'm telling you, even though before I already started for ICAN, because I started from what? I started from 8 years because I was still in school when I qualified it. So I already because I have someone that, so every time when I study the word, and I've provided the trend to you. So you can see it as well that every time you always have question on risk management. And the reason why I read it then was I was doing one course in class then that relates with risk. So the best available resources that you have to have just to go and download ICAN pack then. So I know that it's not really that much. I just see it in just 2 chapters. So I can't forget that. It's just chapter 9 and 10. And still the new pack also they're still maintained because there's nothing that's changed. It's still between chapter 9 and 10. And another thing that you have to do is corporate governance is also very, very important. And majority of the question in corporate governance, if you see the trend I sent to you, is from chapter 11, 12, and 13. Majority of the question is from 11, 12, and 13. Especially 11. You can also conduct some analysis of what I'm saying. Majority time, the question in corporate governance is between chapter 11. And that's what we discuss in the first class. If question come in board of director, which is your chapter 13, is about function of on the roles and responsibility, or they will ask you the audit on the committee. They can ask what we mean by board diversity. And another aspect which when I'm doing revision, I'm going to talk about is ethics. And don't worry, I'm going to review the video, because last diet I was not the one that conducted the class on in CSME. I was not the one, so that's why I didn't. But I think I'll check the Google Drive. So if there's any video that maybe the class they conducted last diet, I'm going to recommend that for us to watch. But I still promise by God's grace, I'm going to discuss all in risks. What you just need to know in risks. In ethics. What you need to know in ethics is about model. And we have 10 model as well under I think 10. We have 10 model under ethics as well. It's not really a scenario. It's just explain the model. We have 5 questions. We have ICAN model, we have AA model. So I'm still going to talk about the model by God's grace on ethics. And ethics is not really that much. So if you're able to be good in what, you're able to be try as much as possible, you are good in what risk management. Risk management is very, very important. Corporate governance is very, very important. And ethics, you know the word, you know the model. So without that, so and the management as well, once you know the model in management and you're able to draw the diagram, management aspect is not something that's very difficult. The problem will start from what? If you do not understand the model that the examiner is asking you, and if you do not understand the diagram, because the diagram also carry the what? The diagram also carry a mark. The lowest the diagram can carry is what is 2 marks. Now, we are asked you to use a certain model, and the minimum that we can give you drawing the diagram, and this one doesn't come, you should come with a pencil or something. Your barrier is enough. A minimum is the lowest we can give a diagram is 2 marks. And 2 marks, 1 mark is also what it can also make a difference. So once you know the model, you're able to know, you know the diagram as well, and please be careful, and God is going to make it easy. And I pray that there are some times that the examiner will just ask you to explain the model without any word. There's no any other problem. Explain what Porter diamond for us. Then you move on. That is all. There are some diet like that. And there are some diet that will give you a simple scenario. So if you want to answer that particular scenario also, you have to see it to be the answer is there. No, I told you in the last class that it's just like a comprehension passage as well. If you want to answer a comprehension passage, where you want to say the answer, majority of the answer is from the passage as well. But if you understand the model, and if you look, it will really help. So try as much as possible. Look at the Excel sheet that I've sent to you. Understand the model. Try as it is much. Even me, that what I'm taking is CSME is not a word. It's not a course. That is a word that is small. It's big, but God is going to make it easy. Try your best. And if there's any question at any time, the WhatsApp is open. Let me know as well. God is going to make it easy. Thank you very much. And at least up to this time, I really appreciate that. So thank you very much, everyone. So please don't forget the tags I'm giving and calculate the ratio. In the next class, by God's grace, we'll do the what? I will do the analysis. Or if I have time during the week, I can do it and send it over. So thank you very much, and God bless us. Enjoy.